Intel stock is selling off after earnings down nearly 6%. And if you only skimmed the headline results, you'd be surprised why it sold off after posting a huge earnings beat. For the quarter, Intel reported 42 cents in adjusted earnings per share, which was 100% above analyst expectations. Revenue for the quarter came in at $16.13 billion, which was 11% ahead of expectations. In fact, the revenue this quarter was up 25% year over year. That's Intel's fastest growth in over 15 years. Now, to be fair, that's coming from a very bad base. In the grand scheme of things, Intel hasn't grown at all in the past 15 years, and they are still down massively from their 2021 highs in revenue. So this is just a small blip upwards, but it is a very positive sign for the actual fundamentals of Intel's business. And the more important thing has to do with the company's earnings. Intel finally looks like it's on a path back to profitability. As I zoom out here to the 10-year, you can see it's down a ton in their earnings per share, but it's starting to climb up again. And there were signals in this earnings report that the company's earnings are going to improve in the coming years. As you can see from this 2020 and 2021 period, they had a huge decline in earnings per share, and it was even negative for nearly an entire year. And this isn't cash flow that I'm talking about. This wasn't because of large capex. It was way worse in terms of cash flow. I'm going to talk about that in a bit. But the actual earning power of the business had declined significantly. And now there's signs that Intel is coming back from the dead. And that led the market to get excited. Initially, Intel stock was up on the latest earnings report. But then, ironically, Jim Cramer, everyone's favorite person they like to inverse, he tweeted, "Intel's the one." And then immediately after that, in after hours, it started coming down. And throughout Friday's market session, Intel stock continued to sell off. And as I'm recording this video, it's hitting new lows on the day, down negative 6.28%. And I've seen quite a few funny things today about people blaming Cramer for the sell-off. And of course, all the inverse Cramer jokes. But Jim Cramer didn't cause this sell-off. What caused this sell-off was the fact that Intel stock was up 322% on the year. That's right, over the past year, it's up that much, when the fundamentals simply had not caught up to that stock price enthusiasm. The current fundamentals of Intel do not signal that the company should be valued at its highest valuation ever, higher than during the dot-com bubble peak. Revenues are still down and only slowly starting to grow again. Operating cash flow is still down significantly from that 2020 period. They were generating $35 billion of operating cash flow in a year, and over the trailing 12 months, they're at $14.94 billion. However, this latest quarter was a good sign. It came in at $7 billion, and that was 240% growth year over year. So Intel is starting to regain some of that business. The company has also been investing a ton into new fabs. These are chip manufacturing plants, and that has been a multi-year capex cycle, and it's been far outpacing their operating cash flow over the past few years while their business has declined. However, this capex is starting to go down, and the company appears to have posted its highest free cash flow quarter in recent history, going back to 2021. And I looked at that and I said, that's great for Intel. They are finally turning it around. However, as I was diving into their earnings report, there's a little bit more of a story there. So today I'll break down exactly why Intel stock is selling off after earnings. I'll discuss when the fundamentals of this company will start to get better, and whether I think this stock is a buy even after going up 316%. And with that said, let's roll the intro and get into this stock analysis video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data. You should leave a like and subscribe to the channel if you enjoy the video. And if you want to use the stock research tool I will be showing throughout, it's all available at dividenddata.com. I had been working secretly for over 3 months to launch this next generation version of dividenddata.com. And to be honest, it's probably 10 times better than the old version. And I think it's arguably one of the best stock research tools on the internet. And to celebrate the launch, we're doing a America 250 sale where you can lock in 50% off annual membership. The link is in the description and pinned comment of the video. There's a 30-day money-back guarantee, so no risk in trying it out. And if you buy right now, you get to keep that discount price for life. So let's dive right into this Intel stock analysis. Now, this is a company that's up 316% over the past year. And let's just talk about the elephant in the room. A lot of that is due more to politics and some implications that surround it. So the US government, they took an equity stake in Intel. And pretty much since then, that basically timed the bottom, and it has been on a rocket ship since then. Expectations are they will get favorable policy, and a lot of companies will be, let's say, persuaded into using Intel's chip fabs that they are building out. And it's very important that they build these out. I am super pro-American, and we need domestic chip manufacturing as much as we can get. And Intel, they are a great business. They're a great company. Historically, going back, the innovations that have happened at Intel, they're awesome. But that doesn't mean the stock makes any sense at the current price, in my opinion. But the fundamentals of Intel, they are starting to improve, and there were a lot of signs in this recent earnings report. And Intel is making a lot of progress in their chip foundry business. This is where they manufacture chips for external customers. Over the past year, Intel, they have made progress. Their new CEO has successfully negotiated some preliminary agreements of potential customers for their foundry business. Now, historically, Intel used to produce the CPUs for Apple's computers, the MacBooks. But over the past decade, Apple has shifted towards designing their own chips. So perhaps longer term, Intel could win them back as a manufacturer of their designs. Other notable things, NVIDIA invested $5 billion in Intel, but there's no official deal there, and NVIDIA gets all of their chips manufactured by TSMC, who is also building up a large domestic US presence. A lot of those fabs are in Arizona, with many more in construction. However, that foundry business, it's still in a very early phase in terms of external customers. And I'll talk about that as I dive into Intel's latest earnings report. And heck, let's just get into it right now, because I'm starting to see some things that I would consider financial engineering within Intel's reports. As we look at Intel's products, their total revenue is $15.1 billion. And this is for the CPUs they make. That's pretty much what they do. They do it for client computing and physical AI group, which is basically the PC business. And that's their largest business segment. And it has been for decades. And over the past decade, it hasn't seen that much growth. It's stagnated and even declined, which is why Intel saw the overall decline over the past few years. Now, the other side of the business, this was for servers, so CPUs in server racks, and that has now been renamed to data center and AI. And there is actually an AI-related application, which is causing an uptick recently. So that's the smaller business, but it's quickly growing, $6.3 billion in the latest quarter, up 59% year over year. And of Intel's business, I'm the most bullish on this one because with the agentic AI build out and the big revolution that's happened over the past year and a half around agents, basically it has to do with computer use and the idea that these models are now using computers. And what are in computers? CPUs. They need to execute tasks, to do things, to use tools. So the big data center build out around AI initially had very little to do with CPUs. However, now a lot of this intelligence is using CPUs, so we need more CPUs. This is why NVIDIA has started designing their own CPU. They have the Vera CPU, and they are going into the PC business and in the data center business, trying to fill part of that demand. You also have AMD, who's also in this business, both in the data center and PC. And then you have Intel, who historically was the number one player. And now there's some more competition, but the overall pie is growing for CPUs. However, it's not to the degree that you're seeing in the memory shortage right now. There's not that level of pricing power happening, but there will be a lot of growth in CPUs over the next probably 5 years. And who knows beyond that? I can't predict the future. So when I'm analyzing Intel's business, this is the one that I find the most interesting. Overall, when we look at total Intel products revenue, $15.1 billion for the quarter, up 28% year over year. So that's what I'm talking about. They're still improving. But as I mentioned at the beginning of this video, that base is still down significantly from its all-time highs. Intel is basically improving to where they were in 2016. Now, I mentioned the part of financial engineering and how they're reporting this, the Intel foundry business. And again, I am definitely rooting for the Intel foundry business. I want it to do well. But they reported $5.8 billion of revenue for the quarter, up 31% year over year. But this is highly misleading. because of what you'll see right here. Inter-segment eliminations, $5.5 billion. Now, what they are telling you is that they are including their own business within their manufacturing or their foundry business. So they are including $5.5 billion of manufacturing chips for themselves, which they've always done. So what that means is that only $300 million of that in the quarter was from external customers, which was the whole idea of why they were building out this foundry business long term. They would like to supply chips for other companies as well, similar to how TSMC manufactures chips for all of these other chip designers. In fact, in this report, I believe they said it was $293 million in the quarter for external customers. So that's why you see the overall total net revenue was $16.1 billion for the quarter, up 25%, which is still improvement for Intel. They're getting better, but this is going to be a multiple year transition. And it's why I've been saying that the stock price has gotten way ahead of the actual fundamental improvement. Now, as we look at the business outlook going forward, they gave guidance for Q3, revenue expectations from $15.8 billion to $16.8 billion. So we're seeing continued growth, especially year over year. Gross margin of 41% GAAP, 42% non-GAAP. And they're expecting 31 cents per share in GAAP earnings per share and 38 cents per share in non-GAAP. Now, this is below the 42 cents they just reported this quarter. So we'll see if they end up beating that. Maybe they're just being conservative, so they have a number to beat. But either way, they'll still be seeing significant growth compared to 2025, where they had 23 cents in Q3. Now, the other weird thing that I found in Intel's report was related to their cash flow situation. Again, I mentioned earlier, they had positive free cash flow, $4.35 billion in the quarter, which is a very positive sign. I was happy to see that. And their operating cash flow was good. It was at $7.01 billion for the quarter, up 241% year over year. And before I get into what was weird about that, I'll talk about why this matters. Free cash flow, it's so important when you're analyzing a stock, because this is all of the cash that's left over that you could potentially reward shareholders with, either via dividends, share repurchases, or you could use it to pay off debt. And this is why when you're valuing a company with a discounted cash flow valuation, you're using free cash flow. And ultimately, a company is worth all of the future cash flow it will generate. Now, what happened with Intel as a case study is that when they went to the foundry business, they had to ramp up their capex significantly. If we look at the annual here, you can see that they went up to $25.75 billion in capex, but that has come down. It was $15 billion last year. But Intel, they got put into a bad situation because they were a company that used to do $35 billion in operating cash flow. And at that same time, they ramped up the capex, it fell to $15 billion. So Intel, they saw negative free cash flow for multiple years in a row. In 2024, it peaked at negative $15 billion of annual free cash flow. So what did that mean? Intel, which historically was a dividend stock, they were a dividend growth stock, increasing it every single year on an annual basis for the most part, other than a couple periods. What did they do? They had to cut that dividend in half, and then they suspended it entirely. And they have not paid a dividend since September 2024, and that's because they couldn't. Likewise, the company used to repurchase shares all of the time, and since they did the foundry, they cut the share repurchases first before the dividend, and we're still getting no share repurchases. So getting free cash flow positive again for Intel, that's a big deal. And for this current valuation to make sense, they're going to need to get significantly free cash flow positive. So what was weird about it? Well, there was something in Intel's report that they had, which was adjusted free cash flow. And this was kind of hidden away in the report. So you can see here, adjusted free cash flow, negative $8.4 billion. And you can see the capex that I was talking about earlier, the $2.6 billion. But Intel's partners, they contributed $12.2 billion into overall capital spending in the quarter. And they had $617 million in leases. And I'm going to be honest, as I'm making this video and preparing for it, I had to do research into finding out what this even meant. So Intel, they're still investing a ton into building out chip fabs. And this adjusted free cash flow is basically how they choose to structure the funding for their new factories. And they break it out across partners and governments when applicable. So Intel, they're basically breaking out the cash flow related to the actual operations of the business, so what they're generating, and the capex related to that. So again, as I'm explaining this, I'm learning this at the same time as you, and I don't entirely get it. But there are $12.2 billion of what they call partner contributions. So the capital spending that Intel is associated with seems to actually be higher than whatever the baseline they gave there. So as I wrap up this Intel stock analysis, it looks pretty expensive at the current valuation. Oh, look, the 1-day now down to 7.8%, and we're 30 minutes from market close as I'm recording this video. And in order for this valuation to make sense longer term, they're going to have to grow a lot. Now, luckily, analysts are expecting continued high earnings growth in the future for Intel, and they have definitely bottomed out. In 2028, they're expecting $2.54 in earnings per share, which at today's stock price, that would imply a 36.7 forward P ratio. And they're expecting continued 50% plus growth after that. And by 2030, that could get them to $5.88 in earnings per share, which would be when it finally hits its all-time high. Again, this company was doing $4.94 back in 2020. So if they grow back to all-time highs, then the forward P ratio would be 15.9 based on today's prices. So let's look at that. I have this tool called the price projection on dividenddata.com. And let's say that at that time, the company trades at a 30 P ratio. So if they actually hit that 2030 target, Intel stock, it could be in a good spot from here. That gives it a projected price of $176.40, up 89% from the current price. That would be 15.5% annually. However, if you imply that same target PE in 2028, that would imply the share price would be $76.31 if it's trading at a 30 P ratio in 2028, which again, this is a higher PE ratio than Google and Microsoft, higher than NVIDIA. That is down from the current price of $93.28. And purely in terms of earnings, short term, the valuation doesn't make sense. You need a lot of fundamental growth in order for it to make sense. I have this tool called the value graph. So based on historical revenue multiples for NVIDIA stock, if you assume the historic price to sales, the company is very expensive right now. It's 240% above the implied fair value based on their revenue multiple. And pretty much every metric is like that, whether it's book value over time or EBITDA over time, operating cash flow over time. With operating cash flow, it's 206% above fair value. Free cash flow, you can't even really do it because they don't have free cash flow. Same with earnings. If they don't have earnings, you can't do it. So that's my thoughts on Intel stock. If you enjoyed the video, make sure to leave a like, comment, and subscribe to the channel. And if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. You can get 50% off annual membership, and the link's in the description and pinned comment below. Thanks for watching, and I'll see you in the next one.